Welcome back to this course on infrastructure finance. This is lecture 25, and in this lecture we will continue our discussion on project finance markets, which we have been doing for a couple of lectures now, and more specifically the focus on today's lecture is going to be on project bonds. But before we start discussing topic on project bonds, we will try and discuss the thought questions that we actually had for the previous lecture. So we had two questions at the end of the previous lecture, and the question number one was what was the impact of soft refinancing. And if you kind of recollect, when we said soft refinancing, essentially it meant that changing the contractual payment patterns of the loan. And so the question here is, when we actually have this kind of soft refinancing, let us say for example, if a 15-year loan gets waived and then it becomes a 20-year loan, then what is the impact of this kind of a refinancing on the project cash flows. So let us try and discuss this with a simple example. So here what I have shown you is I have shown you actually the cash flows of a particular project, and I will first explain you the various columns in this cash flows, so that you become familiar in terms of what is being talked about. And if you look at it, the first column on installment talks about the number of installments in a loan. So we have 16 installments. So essentially this actually is an installment for every half year. So that means there are 16 installments, so that means it is a 8-year term loan. So it is not one installment does not mean a year in this case, one installment actually means 6 months. And then the next column we talk about the base rate value. The base rate value indicates the rate of the loan. So this is the base rate of the loan, and as you actually see, the base rate starts at 6%, it gradually increases to 6.85%, and then subsequently it again reduces to 6.55%. Okay, and then you actually have what is called as your spread. Spread is given in terms of basis points. So BP is nothing but basis points. As you may be aware, 100 basis points is equal to 1%. So when you actually have a loan which is where the interest rate is on a floating rate basis, you actually have a base rate and then you also have a spread, and so the total interest rate is nothing but the base rate plus the spread. So if you look at for installment 1, the current rate of interest is 7.45%. Okay. So 7.45% is nothing but the base rate of 6.25% plus 120 basis points. 120 basis points is nothing but 1.2%, because 100 basis points is equal to 1%. So the current rate of 7.45% is 6.25% plus the basis points of 120, which gives 7.45%. So we actually calculate or estimate the current rate based on the given base rate values and the spread for the different installments. So the interest rate for the remaining installments are calculated the way that we have discussed for installment 1. And then the next column talks about the capital repayment, and if you notice, the capital repayment is constant, that is 70%. Okay. And the question that you may have is 70% of what? Okay. So when you have a constant capital repayment, and this is as a percentage of what? This method of repayment is called as, there is a dedicated percentage repayment method. Okay. So dedicated percentage repayment method, that is 70% capital repayment is made for each and every installment. So this capital repayment percentage is a percentage of operation cash flows. So you have this operating cash flows. So this capital repayment is a percentage of operating cash flows. So the total amount that is actually repaid for debt servicing is 70% of this operating cash flows. Okay. So you have what is called as your debt service, which for installment 1 is 92.17. So how is this 92.17 determined? Okay, 92.17 is nothing but 70% of 131.67. So to illustrate, let me calculate 70% of 131.67. So this is 92.17. So this is a number that is showed as debt service. So the total debt service is calculated as a dedicated percentage of this operating cash flows that we have here. Now this operating cash flows is obtained from the project cash flows that we might have obtained previously. So out of this total debt service of 92.17, part of it is towards principal repayment and part of it is interest. So how do we calculate how much of it is for principal repayment and how much of it is for interest? First we calculate what is the interest payment that is being made. For example, the beginning there is an outstanding debt of 1000, and for installment 1 the rate of interest is 7.45%. So therefore the interest for installment 1 is calculated and that is 37.25. So how do we calculate this interest? So again let me illustrate. So we have the total interest outstanding, which is 1000, and then we have the current interest rate, which is 7.45%. So the current interest rate of 7.45%, but you should remember that this interest rate of 7.45% is for an entire year, and as we have discussed previously, each and every installment is for 6 months, that is for half an year. So therefore the interest that is due for installment 1 has to be calculated for 6 months. So that means we divide this expression by 2. So you actually get the interest of 37.25, so which is what I have indicated here. So once you actually know the interest that you pay for that installment, the balance of the debt service is going to be capital repayment. Okay. So for the sake of your understanding, let me do it once again. So capital repayment is nothing but this equals your debt service net of the interest that is paid. Okay. So that is your 54.92, which is the same figure that we had previously. Now during this particular installment we have repaid principal of 54.92, and therefore the outstanding debt at the end of 6 months is 945.08. So how do we get that? We have the outstanding debt of 1000, and then from that we subtract the capital repayment for this particular installment. Let me illustrate again for the quarter 1 for installment 1. So this is nothing but your outstanding debt of 1000 and subtracted by your capital repayment, and this gives you the outstanding debt at the end of installment 1 or at the end of 6 months. Okay, so this is 945.08. And the next column talks about repaid loan, which is a cumulative number. So at the end of installment 1 the repaid loan is 54.92, and the last column talks about DSCR, which is your debt service coverage ratio. So in this case the debt service coverage ratio is a simple number, which is nothing but the operating cash flows divided by the debt service that is due for that particular installment. Okay. So if you want to calculate this, this is nothing but the operating cash flows, which is 131.67 divided by the debt service for that particular half year period, which is 92.17, and if you divide you actually get the debt service coverage ratio which was there previously. So, debt service coverage ratio gives an indication of how much the operating cash flows, or how many times of debt service does the operating cash flow is to kind of meet the debt service obligations. Okay. So, this is how we actually calculate this the capital and interest payment table for this particular example. So, like the same way I have illustrated for installment 1, you calculate for the entire 8-year period. Okay. So, now you actually have the debt service coverage ratio. Since the capital repayment is a dedicated percentage of the operating cash flows, the debt service coverage ratio turns out to be an uniform number for all the installments except the last one. So, in the last one obviously we actually have an outstanding debt which is lower than what is actually need to be paid, and therefore which is lower than 70% of the operating cash flow. So, therefore we pay the entire debt service in installment 16, and given the fact that the operating cash flows are much more than what the outstanding debt is, we actually have a higher debt service coverage ratio of 3.41. So, this is let us say what has been the agreed upon loan terms at the beginning, okay. And later on let us assume that there has been a soft refinancing, okay. Later on we assume that there has been a soft refinancing, and I am actually going to show you the table for the soft refinancing, okay. So, this is, let us assume that is the soft refinancing. There are two things that happen here. One is the dedicated percentage gets reduced from 70% to 60%. So, earlier this dedicated capital repayment was 70%, now it becomes 60%, and when it obviously becomes 60%, the number of years over which the repayment will happen will also going to increase. So, therefore, the installment has increased from 16 to 21. So, what was initially an 8-year loan, now it has become a 10.5 year loan, okay. So, these are the two things that have actually happened. We are actually reducing the capital repayment percentage and we are increasing the tenor of the loan, and the base rate value and the spread in terms of basis points are given for each of the installment periods, and we calculate the current interest rate for the respective installments. And if we actually calculate the remaining columns as well, we will be able to find out, we will be able to get the numbers that I have shown in the spreadsheet. Okay. So, in this case the debt service coverage ratio happens to be 1.6667. Okay. So, the debt service coverage ratio has increased as a result of this soft refinancing. Now, what is the objective of this kind of soft refinancing? What are we trying to achieve? What could be the benefit to the project because of this soft refinancing? Okay, so the single most important benefit would be the additional cash reserves that gets released. So, normally what happens when you actually have a loan repayment, there is a need to be creating what is called as your debt service reserve account. So, that means you need to create a reserve account which will have a certain amount of cash in it, so that if there are any delays, if there are any shortfalls in cash flows from the project operations, the debt will be repaid from the debt service reserve account. Okay. So, the amount of cash that is there in the debt service reserve account is not available for any other purpose. So, that is the cash that is stuck in the system. So, if you are able to do a refinancing, if you are able to do a soft refinancing, we will be in a position to release the cash, at least if not the entire amount, at least some amount of cash that is there in the reserve accounts. So let us see how this works. Let me go back to the first spreadsheet that we talked about, which is your the original repayment schedule of 70% capital. Okay, now if you assume that there needs to be a debt service reserve account that is created, which will have a minimum of reserves that will equal the next, which will, or that will equal the next 5 debt service amounts that needs to be paid. So for example, in this case, if we need to find out what should be the amount that should be there in the reserve account, it will be the sum of, let us say, the first 5 amounts in the debt service. Okay, so that if you create, let us say for example we create the sum of the debt service amounts for the first 5 periods. Okay, so this will be the total amount that will be needed in the debt service reserve account. So this works out to be 464.88. so much of cash needs to be cut, so much of cash needs to be there in the debt service reserve account. Now I will go to the scenario after refinancing when we lower the capital repayment to 60%. Let us see how much cash needs to be there in the debt service reserve account. Okay, so I am going to actually calculate the sum of the cash flows for the first 5 periods of debt service. Okay, so this is the debt service requirement for the first 5 installments. So a sum total of all this is needed for the cash for the debt service reserve account. So this happens to be 398.47. Now when we compare the cash that needs to be there in the debt service reserve account as per the original, which is your 464.88, so you know there is a difference here, right. When you actually do a refinancing, the amount of cash that is needed in the reserve account is lower than what it was in the original repayment schedule. So we actually see release of about 66.41 that was stuck up in the reserve account. So this cash that gets released can be very invaluable for the project company. So this is one of the benefit of a soft refinancing. Next we actually go to what is called as the second thought question. The second thought question is, what are the advantages of refinancing using bonds as compared to a syndicated loan. Okay, so in this case we are talking about hard refinancing. Okay, we are not talking about a soft refinancing, we are talking about a hard refinancing. We have a new set of investors who are buying out the existing lenders, and what are the advantages of this kinds of refinancing. Now there are several ways in which you can look at it, but I am going to present one perspective of this refinancing. Again let me take an example of a typical project and then see how it works. Okay. So let us look at the original loan repayment period. So the project cost is 300 and the project is financed by a 75% loan, and the loan term is 3 years. So if you actually look at the project period, the first 2 years is the construction period, and then the next 4 years is the operating period. Okay. And we have what is called as your project estimated EBITDA. During the construction period obviously there are no revenues, so therefore the project investment, the project EBITDA is 0, but then during the operating period the project gets some revenues, and we estimate it to be 120 in each of the periods. Remember, you should also consider the fact that this is a very simplistic example, and therefore we have kind of assumed the project EBITDA to be uniform in all the 4 years and so on. But in reality, in projects you may actually not find instances where the project EBITDA is the same for each of the operating years. And then we have what is called as your project investment. The investment actually happens during the construction period. Again, we have assumed the investment to be uniform in each of the 3 years, 100 now, 100 during first year, and 100 during the second year. Okay. So you have what is called as 300, and the 300 investment happens equally in 0, 1 and 2. And then we talk about the cash flows, okay, and then we talk about the cash flows. And when you actually talk about the leveraged cash flows, then you actually have during the project construction period there is no other cash flows. The only cash flow is the investment that is being made in the project, which is in the nature of a cash outflow. So therefore the free cash flow is nothing but a negative value of 100, 100, 100. Okay. Actually you actually look at in the operating period, the free cash flows is nothing but the project EBITDA. So actually you find a scenario where there is a small error here. This is not 110, but this equals the project EBITDA. So I am actually going to make it equal to the project EBITDA. Okay, so this becomes your so this becomes your 120 120. And then we have interest costs during the construction period. So obviously there are no interest that are paid, so it is 0, but we assume that the interest is 8%, and during the operating period when the firm has cash flows, then obviously the interest gets paid. Then we have what is called as a debt withdrawal. So out of the total investment of 100, how much of it is being paid by debt, how much of it is being met by debt? And we talked about the loan component is 75%, the balance coming in by equity. So therefore the debt withdrawal is 75, because the investment is 100, the 75% of it is loan, so therefore the total debt is 75. So we have 75 for each of these 3 periods, and then during the operating period we are obviously not utilizing any further debt, so therefore it is 0, 0, 0, 0. And then there is capital repayment. Capital repayment is basically the capital that is being repaid during the construction period. There is no capital repayment, so this figure turns out to be 0. Equity contribution is 25, which is nothing but the project investment minus the debt withdrawals. So this is 25 in each of the periods. And then the free cash flows to equity is 0 during the construction period. The equity holders do not get any profits because there is only cash outflows, so this is 0. And then cash flows to sponsors is negative 25. This is basically the investment that they actually make in the project during the construction period. So next we actually calculate some of the other values. In the operating period we actually pay interest, so this is 8% of the interest that is outstanding. And then we have the capital repayment. It is a 3-year loan. The capital is, we assume, is paid uniformly during the 3-year period. And then the free cash flows to equity is nothing but after the debt has been paid, what remains to the equity holders. So the cash flows to equity is the cash flows to sponsors, so therefore both these cells are equal for all the periods. So next we now we actually look at how do we calculate the interest. At year 0 we have taken a loan of 75 and which becomes an opening loan of 75 in year 1. In year 1 we again take a loan of 75 and then we have interest. For example, we have to actually when we start withdrawing a loan we obviously have to pay interest, but during the construction period this interest is not capitalized, this interest is not paid but it is capitalized in the sense that it becomes part of the principal. So therefore when you look at year 2, the opening loan outstanding is also including the capitalized interest. So this is 162 is nothing but 75 the beginning of the project, 75 of loans taken during the year 1 and then the capitalized interest. So the total outstanding loan at the end of year 1 becomes the opening loan outstanding year 2, and we take a loan of 75 in year 2 and the total interest during year 2 works out to be 18.96, which is nothing but 8% of 162 plus 75, this is 18.96. So the total outstanding loan at the end of year 2 becomes 255.96. So this 255.96 is the opening loan outstanding when the project begins operations. Okay, so when the project begins operations the total loan outstanding is 255.96 and this is the loan amount that needs to be repaid in 3 years. Okay, so therefore what is the loan amount that has to be repaid every year? So we actually divide the total opening loan outstanding at the beginning of the construction by 3 and that actually becomes 85.32. We repay 85.32 in each of the 3 years, and because of this repayment the outstanding loan at the end of the year gradually reduces. For example, at the end of year 3 the outstanding loan gets reduced to 170.64 because we have paid an interest of we have repaid a principal of 85.32. We also have to calculate the interest costs. The interest costs are nothing but 8% of the opening loan outstanding. Okay, so the opening loan outstanding is 255.96 and we pay 8% of that and the interest cost becomes 20.48. So this interest cost and this principal repayment is what is indicated here, 20.42 and 85.32. Okay. So now the free cash flows to equity is nothing but the cash flows that goes to the equity holders after servicing the debt. So how do we do that? So for example, I'll give you as an illustration. So this is nothing but the free cash flows, unleveraged free cash flows 120, and we subtract the interest that is being paid and then again we subtract the capital repayment or the principal repayment. So what you get is 14.20, which is the cash flows to equity. So we calculate the remaining values for years 4 and 5 like I have indicated for year 3. After doing this we will be able to calculate the project IRR and the sponsors IRR. Okay, project IRR is calculated using these cash flow details. Okay, so we have an investment of 100 the first 3 during years 0, 1 and 2, and then we have cash flows of 120 in each of the years from years 3 to 6. So project IRR is nothing but this IRR. I am going to use the IRR function in Excel and then use this cash flows to calculate the IRR. So it comes 14.55. Okay. And then if you look at the sponsors IRR, the sponsors IRR is calculated using the cash flow information given in this row. right. We have the cash flows to sponsors, and these cash flows to sponsors are used to calculate the sponsors IRR. So, the sponsors IRR turns out to be 22.78. Now, if you actually look at the debt service coverage ratio, the debt service coverage ratio, as we have seen in the example of soft refinancing, it is nothing but the free cash flow divided by the total debt service requirement, which is the interest and the principal repayment. Okay. Remember, I mean, what we are trying to do here is a debt service coverage ratio is a very simple approximation. Okay. The detailed debt service coverage ratio calculations will have to consider the tax when we actually the tax that the company will have to be paying for. Okay. So, this will actually give you a figure of 1.13. Okay. So, before refinancing we have the following indicators. The debt service coverage ratio is 1.13, 1.21 and 1.3, and the project and the sponsors IRR happens to be as follows. Okay, now let us assume that the loan has been refinanced. Okay. Okay, now let us assume that the loan has been refinanced. That means at the end of the construction period, the entire loan that was outstanding is being refinanced by a new form of loan. So, the project cost is 300, which is what it is, and which is what has been used for construction, and 75% has been loan, like we have seen earlier, but then the original loan is refinanced after construction period by a 4-year loan, and this 4-year loan has an interest of 9%. Why the interest is 9%? Because it is a long term loan, and therefore the interest rate is higher. We have already seen that the yield curve is positive sloping generally. That means as the loan maturity period increases, we also will have an increasing interest rate. Okay, so that is what we see here. So, what we actually find, I am actually going to change the free cash flows to 120 here, like we have seen earlier. Okay. All right. So, now the refinancing happens of the total outstanding loan at the end of the construction period. So, we have 255.96, which was a loan that was outstanding at the end of the construction period. So, that loan is being refinanced by a 4-year loan with an interest rate of 9%. Okay. So, this 255.96 is repaid over a 4-year period. Okay. The equal installments over a 4-year period it is being repaid. So, that is your 63.99. So, for example, if we divide 255.96 by 4, that will give us the amount needs to be paid every year. So, that is 63.99. We pay 63.99 every year, and we pay an interest of 9% on the outstanding loan. So, the outstanding loan was 255.96, and we actually look at paying an interest of 9% on this outstanding loan at the beginning of the operations. So, this is 23.04. So, similarly we will have to calculate the interest cost on the loan outstanding at the beginning. Okay. The loan outstanding at the end of year 3 was 191.97, because we have paid a principal of 63.99 during the year, and this outstanding loan at the end of year 3 becomes the opening outstanding in year 4, 191.17. So, we therefore have to calculate the interest for year 4 based on this opening loan outstanding. So, for example, we have to calculate 9% of this opening balance, which is 17.28. So, you actually calculate all the values for the remaining periods as well. Now, let us compare some of these indicators in the original loan and the refinance loan. Let us talk about project IRR. Okay. If you go to the original loan, the project IRR was 14.55%, and in the refinance loan the project IRR is 14.55%. So, the project IRR has not changed. Okay. Then what has changed? Let us look at the sponsors IRR. The sponsors IRR in the original loan was 22.78, but if you look at a refinance loan it is 24.71. So, the sponsors IRR has increased because of this refinancing. Okay. So, this is an important objective of refinancing. You are able to increase the IRR of the sponsors. If you also notice, the debt service coverage ratio has also increased. Okay. It is 1.38 after refinancing, but whereas in the original loan it is 1.13. Okay. How has this increased? This has increased because the amount of debt service needed for each of the years has reduced. We are actually paying the loan over a longer period. So, therefore, the installment for each of the years has reduced, and therefore, the debt service coverage ratio has increased. Okay. So, these two examples will give you some of the benefits of refinancing. Okay. We are able to actually release additional cash into the system, and by using a hard refinancing we are also able to increase the sponsors internal rate of return. Okay, now after having discussed the thought questions, we will come back to what we wanted to discuss today, which is about project bonds. Okay. We have also talked about project bonds and loans in the previous lecture, but let me quickly sum it up as to what do we actually mean by project bonds. So, essentially if you want to look at a project is financed by two sources, and very broadly we have equity and then we have debt, and debt can be again classified into two categories. One is your syndicated loans and the others are bonds. Okay. So, when you talk about project bonds, I largely mention to this. Okay. These are essentially it's very similar to let us say a loan, in the sense that it also has a maturity period, it also has an interest that needs to be paid, but it just that the investors are different in a loan as compared to a bond. In a loan it is largely banks that actually come and participate, whereas in a bond we actually have financial investors as well, and if the bonds are placed if the bonds are publicly sold, then we also have retail investors. Okay. And why do firms issue bonds? Okay. The firm has two alternatives, loans and bonds. Then under why should firms issue bonds? So, the logic is when you actually take a loan from the bank, where do the banks get their funding from? The banks get their funding from depositors, or the banks get their funding from other financial institutions. Okay. So, the bank does not have generate cash on its own. Bank is a financial intermediary by trying to get capital from other sources. So, the logic here is, instead of approaching the sources of capital through a bank, the project company can directly approach sources of capital. So, you can directly approach financial institutions, you can directly approach retail investors. So, that is a logic of issuing bonds. If we actually bypass the bank as an intermediary, there are some benefits. Obviously, there are some advantages of going through a bank, but there are some advantages if you directly approach the investors instead of through the bank. Okay. So, that is the logic why bonds is an important source of financing the project. Another important difference is bonds are securities that are traded in the financial markets. you do not actually find syndicated loans being traded under unless until there is exceptional circumstances, but bonds normally are traded in the financial market. There are some restrictions, and so for example, if you look at a private placement bond, there are some restrictions on how long you should continue to hold the bonds before you can actually sell it to a secondary investor. But there are several instruments and schemes that are available which tries to minimize the holding period. So practically speaking, bonds are a lot more liquid for the investors as compared to syndicated loan. Another important characteristic of the project bond market is the project bond market is not as large as the project loan market for various reasons. The projects are very specialized entities, and it is going to be very difficult for the projects to directly approach the investors. So therefore approaching through a bank is a lot more beneficial. So therefore the project bond market is lower. But it should also be remembered that the project bond market is growing very fast, and that is a very important development that we should be aware of. Okay. Next we try and look at why is there is a lot of growth in the project bond market. Generally there are four main reasons. One is there is a need for large infrastructure investments, and when the need for capital is so large, we need to tap as many sources as possible, we need to use as many instruments as possible. So therefore in addition to syndication loans, people are also using bonds as a source of capital. And second, institutional investors are looking for alternative investment opportunities. So in addition to the existing investment opportunities that they have in the capital markets, institutional investors like pension funds, mutual funds, university endowments, insurance companies, they are looking at investments in assets, investments in infrastructure assets. So they have over a period of time developed the expertise in understanding and evaluating the risks of this, and if there is a good investment opportunity today, they are willing to invest. So there is a demand from the institutional investors to make these kinds of alternative investments. And three, an important feature in a bond is the bonds have to be rated by credit rating agencies. Okay, and before we actually go out and sell the bond should carry a credit rating. The credit rating is an indication of the quality of the bond in terms of timely payment of principal and interest, and the retail investors look at the credit rating as a very important information source in their investment decision making. So in recent years, credit rating agencies have developed the expertise to rate project finance bonds. So therefore this is another factor that catalyzed the growth in the project bond market, because more and more markets are being rated by the credit rating agencies. And fourth, the experience of the project bond market has been positive. There is a lot of bond issuances that happened in the US initially, and investors in these bond issuances have obtained positive returns. So therefore this positive experience is also another factor that is driving the growth in the project bond market. When you look at project bonds, they can be categorized into various ways. We categorize based on the nationality of the issuer. Is it a domestic bond or a foreign bond? If the bond is being issued in the same country in which the issuer is, then it is a domestic bond. For example, an Indian company is issuing a project bond market in the Indian market, so that is actually a domestic bond. On the other hand, if an Indian company is issuing the bond in the US, then it becomes a foreign bond. Okay, so the nationality of the issuer is very important. And in most circumstances, if the requirement of capital is very large, it is not possible to mobilize the capital from one market. So therefore you will have to look at getting capital from many markets. So you will have to look at not only domestic markets but also foreign markets. Okay. Then bonds are also classified by the investors in the bond. Say for example, whether you want to actually have institutional investors or whether you want to have retail investors. and when you are actually selling the bond to the institutional investors, it is called as what is known as private placement. Okay, so you actually instead of offering it to the public, you privately place these bonds to institutional investors, you make them subscribe to these bonds, and then you get the capital. So again, there are both the limitations and advantages of who your investors are. Are they going to be institutional investors, or are they going to be retail investors? And then there is also existence of guarantees. Should the project bonds have guarantees, and what kind of guarantees? So that means we are talking about should the bonds be secured or it should be unsecured. When you are talking about secured bonds, so that means the cash flows to the project to the bond holders are secured by the assets of the project. So in this case, in a project finance, the assets are nothing but the cash flow rights. So therefore the lenders, the subscribers to the bond will actually have the first right, the cash flows that accrue to the project. Okay. So there are unsecured bonds as well, we talked about earlier. These are largely called as subordination bonds. So normally when you actually look at it, institutional investors will unlikely invest in a bond which actually has junior claims, that is, which is subordinated. So therefore you always have institutional investors investing in a secured, most cases you have institutional investors investing in secured loans. And then we talk about the interest and capital repayment. How is the interest being paid? Is it going to be a fixed interest rate, or is it going to be a floating interest rate? So how is the capital going to be repaid? Is the capital going to be repaid during the loan term, or is it going to be repaid at the end of the loan term at one shot? So these are all some of the terminologies that we actually use to categorize the bonds. Okay. We will talk about some of these categories in greater detail in the following lecture, but to end this lecture I have the following questions for you.